In this video, I'm going to show you a strategy using the Heikin-Ashi indicator. It's great at finding trends and even better at finding reversals. I'm also going to be adding another indicator to this strategy to make it that much more effective. Let's get straight to it. For all the beginners out there, or for the people who don't know what the Heikin-Ashi indicator is, let me give you a quick overview. So what we're looking at now looks as if it's just a normal chart, right? Well, actually we're looking at the Heikin-Ashi indicator at work. Heikin-Ashi actually means average bar in Japanese. So that's exactly what it's doing, finding the average in the candlesticks. So this is the real-time chart and this is the Heikin-Ashi chart. So just make sure in the back of your head, you know the Heikin-Ashi is not the real price, it's the average price. Instead of just looking at the Heikin-Ashi candles, we're going to be looking at both the real time and the Heikin-Ashi at the same time, so we can read and understand the chart better. To do this, just go to TradingView, go to the indicators tab, and type in Heikin-Ashi. This will show both the real time candles above and the Heikin-Ashi candlesticks right below it. Now that we have the indicator added, let's move on to the strategy. So when trading, it's a lot harder to find trends than you might think. Not all trends are going to look this simple and just have all green candlesticks going up. Most of the time they're going to look like this, a strong trend going up but having multiple pullbacks with red candlesticks, which also might give you false signals on when to sell. That's where the Heikin-Ashi comes in. Instead of looking at this trend with a bunch of false signals that may get you to panic sell, we're going to be looking at the Heikin-Ashi. In most cases, it'll have all the same color candlesticks and a strong trend. This way, it's easier to identify the trend in real time. That's exactly what the Heikin-Ashi is for. It helps eliminate unwanted noise and shows a clearer version of the price movement. Let's move on to how to identify the trend. There are 3 simple rules you must follow. To identify an uptrend, the Heikin-Ashi candlesticks must be green, they must have large bodies, and they have no lower wicks. In this example, this would be a strong long trend. All the candles are green, they have large bodies, and they don't have lower wicks. It's the complete opposite for a downtrend. All the candlesticks must be red, have large bodies, and have no upper wicks. So we all know charts gain and lose momentum all the time. After a strong upwards trend, most of the time, the chart will lose momentum and do a reversal in the opposite direction. Luckily, the Heikin-Ashi is great at finding when that moment is about to happen. You can identify when a reversal is about to happen by this. A doji candle. A doji candle is a candlestick with wicks on both sides, has a small body, and it can be either color depending if you want to go long or short. So we're going to take advantage of what we just learned. The only rule you have to follow is you only enter after you see a doji candle, and you wait for 2 candles in the opposite direction with opposite features. Let me show you an example so you know what I mean. So here you can see the price is making a downtrend. Then we see the chart make a doji candle in the opposite color, which indicates that there's a very good chance the price will make a reversal. Then we wait for 2 green candles with only wicks on the top to appear to confirm the reversal. If the candle has a wick on the top and the bottom, we do not count that candle. Once the second candle with a wick only on the top appears, we enter the trade. So this right here will be our entry signal. Let me show you an example of a short. The market is in an uptrend. We wait to see a doji candle appear in the opposite color. We then wait for 2 large red candles to appear with only wicks on the bottom. Once we see the 2 candlesticks, we enter the trade. So that's the Heikin-Ashi indicator explained simply in a nutshell. Now I'm going to show you how to add another indicator to this strategy to make it that much more effective and, more importantly, more profitable. The indicator we're going to be adding to the strategy is the stochastics indicator. I'm not going to be going too in depth with this indicator because 1, it's very simple to use, and 2, I don't want this video to be too long. To describe it simply, the stochastics indicator is a lot like RSI, as in if the lines are crossing above the top line, the market is being overbought. If the lines are crossing below the bottom line, the market is being oversold. So as an example, here the lines are crossing below the bottom line, indicating the market is oversold, and it's likely to reverse upwards. Just like most indicators though, this indicator by itself isn't very good, but combined with other indicators, is, it's extremely powerful. To add this indicator, go to the Indicators tab, type in Stochastics, and click this one right here. Now let me show you how to combine these two indicators to make a very powerful strategy. First things first, if we want to go long, we want to find a point in the chart where the Stochastics indicator is crossing below the bottom line and there is weak downwards momentum. We do not want to enter a trade if the Stochastics lines are crossing below the bottom line and there's strong downwards momentum, because odds are the price will keep on falling. Here's a perfect example. The Stochastic lines are crossing below the bottom line. There's a downtrend, but a very weak downtrend. We then wait for a doji candle to appear. Once it does, wait for two large body candlesticks with only wicks at the top, then we enter the trade. Here's one more example. Stochastic lines are crossing below the bottom line. There's a weak downtrend. Wait for the doji candle. Wait for two large green candles with only wicks on top. Enter the trade. Profit. I just showed you a profitable trading strategy using the Heikin-Ashi and Stochastics indicator. All I ask in return is if you take 2 seconds out of your day and like this video. If you want to see one of the strategies I use when day trading, check out this video right here, because this strategy works great on the 1 minute time frame. I'll see you guys next time. In this video, I'm going to show you a simple scalping strategy that works perfect for the 1 minute time frame. It uses a special indicator called the Williams Fractals indicator, and we're going to combine it with some other indicators to make it that much more effective. It's easy to use, works in almost all markets, and most importantly, it works. Let's dive straight into it. First things first, get on TradingView or whatever trading chart platform you use. Right now, I have my time frame set to 1 minute, but this strategy will work for almost all time frames. Let's add the Williams Fractals indicator first. To do that, go to the Indicators tab, type in Williams Fractals, and it's going to be the one right here. The default settings will work perfect. Just make sure the period is set to 2, and for the colors, it's originally red then green, but I flipped them to green then red, so it's easier to understand when reading the chart. Next, we're going to add some moving averages. Go back to the Indicators tab and type in 3 moving averages. It should be this one by Advent Trading. Once you have that added, we're going to change the settings a bit. Go up to the settings of that indicator, change length 1 to 20, change length 2 to 50, and length 3 to 100. Then for simplicity's sake, I'm going to change the colors of the lines to green, yellow, and red in that order. Now that we have the indicators added, let's go on to how the strategy actually works. The first rule of this strategy is you can only go long if the 20-day, the green line, is above the 50-day, the yellow line, and the 50-day is above the 100-day. If they are crossing each other like this, then you should not enter the trade. It's the complete opposite for a short trade. So the 100 should be on the top, the 50 in the middle, and the 20 on the bottom. Now that we know how the moving averages should look, let's move on to know when to enter into a trade. To enter a long trade, the price has to pull back under the 20-day moving average or under the 50-day moving average. Then you also have to see a Williams fractal green arrow. This will be your entry signal. Let me show you an example so you can better understand what I'm talking about. So first things first, we made sure the moving averages are in the correct order and they are not crossing each other. Then we wait for the price to cross under the 20-day moving average. We keep waiting till the Williams fractal indicator gives us the green arrow for the go-ahead to enter the trade. Once it does, we create a long position, put the stop loss right below the 50-day, and then have a 1.5 profit ratio. As you can see in this example, the strategy worked out perfect and we made money. If the price keeps moving down before the Williams fractal gives a green arrow and crosses the 50-day then gives a green arrow, you're going to do the same thing and enter the trade here, but this time you're going to add a stop loss right below the 100-day and still set a 1.5 ratio. Now, there's a very important rule you must follow for this trading strategy to be profitable. If the price moves below the 100-day moving average, you do not enter a trade on the green arrow from the Williams fractal indicator. So as you can see here, the price moves below the 100-day, then the Williams fractal gives a green arrow, and as you can see, the price drops again. So if the price ever closes below the 100-day, just disregard the next green arrow, because the chance that it'll drop even more is a lot higher. higher. Now let's take an example of a short trade with this strategy. First, make sure all of the lines are in the correct order with the 100-day on top and the 20 on bottom. Then we wait for the price to cross above the 20-day, then wait for a red arrow from the Williams fractal indicator. Once we get the signal, we enter the trade here, add a stop loss right above the 50-day, and then set a 1.5 profit ratio. You should also understand that you have to trust this strategy. It may take some time before the price hits your profit mark. You have to trust this strategy and stay in it. As an important note, you should also realize that you will get a ton of buy signals, especially if you're trading on the 1-minute time frame. If you are, it's extremely important you make sure that your broker or exchange has very low fees. Otherwise, the fees will ruin the gains because of the volume of trades you're taking. I just showed you a winning strategy using moving averages and Williams fractal indicator. All I ask in return is if you take 2 seconds out of your day and like this video. If you want to see one of my top favorite strategies I use on a daily basis, check out this video and I'll see you guys next time. Show you a strategy that involves trading with the trend. I'm going to give you a combination of indicators, a list of rules to follow, and show you a scalping strategy that has been back tested and proven to work. It works with almost all markets, all time frames, and most importantly, it works. What I see a lot of people doing is trying to buy the absolute low on a downtrend and trying to hit that exact point of a reversal. And while yes, it would be nice to hit that exact point of a downwards reversal and make a ton of money when it reverses, it's extremely unlikely you'll find that exact point the majority of the time. If you've watched my videos before, I'm all about probability and success rate. I'm a huge fan of trading with the chart, not against it. What I mean by that is that I will only enter trades if the chart is in an uptrend. With all that said, let's get started with this strategy. Rule number 1, and probably the most important rule, is that we will only be trading with the trend, at least with this strategy. You may be asking yourself, how do I know if a chart is in an uptrend or a downtrend? Well, it's pretty simple. Just go to TradingView, click the indicators tab, and type in EMA for exponential moving average. Then go to the settings of the indicator and change the length to 200. This will give us a 200-day moving average. I'm also going to change my line to red just so you can see it better, but this is optional. So with this strategy, we will only enter a trade if the chart is in an uptrend, which means we will only enter a trade if the price is above the 200-day line. If the price is below the 200-day line, we will not enter the trade. So this is the first rule of the strategy. You must be trading with the trend, meaning we will only enter a trade if the price is above the 200-day line. Now that we know rule number 1, let's move on to the rest of the rules that must be met in order for you to enter the trade. Rule number 2 involves using the RSI indicator, but with a twist. Go to the indicators tab and type in RSI divergence. Make sure to pick this one right here. Next, we're going to change the settings a bit. Go to the settings, then uncheck these bottom 3 checkboxes, so this will clean our chart up a bit. Then go to the middle line tab and change the color to white and make it a solid line. This is just so it's easier to see. Now, usually the RSI indicator is used for seeing if the market is overbought or oversold, but in this strategy, we're going to be using it to find momentum in the market. So rule number 2 is that we will only enter a trade if the RSI line is above the middle white line. If all the other rules are met and the RSI is below the line, we will not enter the trade. The cool thing about this customized RSI indicator is that it also shows divergence. If you don't know what divergence is, to put it simply without going too in depth, it's basically when the price is moving in the opposite direction as the indicator. So if you're seeing higher highs on the chart and lower highs on the RSI, that's divergence. The cool thing about this RSI indicator is it will automatically show us if bullish divergence is occurring. As a quick disclaimer though, I've seen this indicator mess up and not show divergence sometimes, so you may have to look yourself a time or two. Just keep that in the back of your head, but nonetheless, this is a great indicator. So this bullish divergence is not exactly a rule that we have to follow, but it's a great sign if you see it when all the other rules are aligned. Let's move to rule number 3. If you've watched my other videos before, you probably know I love momentum candles. This can be a great way to find the start of a trend. The specific momentum candle we're going to be looking for is what is called an engulfing candle. To put it simply, an engulfing candle is a candle where it engulfs the previous candle. A bullish engulfing candle opens at or lower than the previous candle's close. The length of the bullish candle's body engulfs the previous red candle. Then the bullish candle closes above the previous candle's open. This is an engulfing candle, and it's a great way to find the start of a trend. Instead of looking for this candle ourselves and just looking at the chart all day, we're gonna let an indicator do the work for us. Go to the indicators tab and type in engulfing candle. You're gonna choose this one right here. When you add it, you're gonna be seeing a bunch of red and green arrows. Since we're gonna be doing long trades in this example, you can just disregard the red arrows. So all of these green arrows are bullish engulfing candles. Rule number 3 is we will only enter a trade if we see a green arrow. So let's go over what a successful trade would look like. 1, we see the price is over the 200-day line, which implies the chart is in an uptrend, so far, so good. We then make sure the RSI line is above the 50 mark, which it is, so we're all good there. We do not need to see a bullish divergence, but if we do see one, it's a +1 and makes this trade even more bullish. Next, we look for a green arrow, which I should also mention right now, we will only enter the trade after the green arrow candle closes. I repeat, only enter after the green arrow candle closes. This candle could show a green arrow, but then change while the candle is still forming and not end up being an engulfing candle when it closes. So once the candle closes and there's a green arrow, we will enter the trade then. For this specific strategy, we will set our stop loss 2 times the length of the entry candle. We then set our take profit to a 2-to-1 ratio. It's that simple, and boom, as you can see, the price hits our mark. Now, if you're one of those people who gets panicked easily or gets out of trades too early or late, literally just set your take profit, set your stop loss, and just close your computer and let the strategy do its work. This will help you stop trading emotionally and selling too early, or even worse, getting greedy and moving your take profit. It is also important to note you probably won't be trading every day with this strategy, since we're only trading with the trend. The chart isn't going to be in a trend 100% of the time, so there will be days where you simply won't be able to trade. This is okay. You just need to understand that this is a thing, and you will only trade when the market is working for you, not against you. Let's do one more example. First, we make sure our price is above the 200-day line. We then make sure the RSI is above the 50 line. We also see that the RSI has a bullish divergence, which is not needed, but it increases the chance that this will be a winning trade. So that's good. Then we see a candle with a green arrow under it, indicating it's a bullish engulfing candle. We then wait for that specific candle to close. Once it does, we enter the trade. We set our stop loss 2 times the length of the engulfing candle, then put our take profit mark to a 2 profit ratio, then wait. We see the price move up, hit our take profit mark, and we exit the trade. I just showed you a successful trading strategy that works great because you trade with a trend. All I ask in return is if you take 2 seconds out of your day and like this video. It seriously means the world to me and helps me out so much. If you want to see my secret strategy to avoid false breakouts, watch this video because there are some pretty insane hidden gems in there that'll improve your trading so much. Thanks for watching, and I'll see you guys next time. I'm going to show you a trading strategy that works so good, I just have to tell you guys. And it involves using Bollinger Bands and RSI. It's simple, easy to use, and it has a pretty high success rate if you use it correctly. Well, enough talk. Let's get straight to it. The first step for this strategy is setting up the Bollinger Bands. If you've never used Bollinger Bands before, you're lucky you clicked this video, because this indicator is absolutely incredible, and it's a pretty great way to find support and resistance levels. So the first thing we want to do is go to TradingView or whatever trading chart platform you use, click the indicators tab, and type in Bollinger Bands. Now, the default settings TradingView will give you are pretty nice, but we want to change them for this specific strategy. First thing you want to do is go to the length section and change the value to 30. Make sure the standard deviation is set to 2. Then I'm also going to remove the background of the indicator. This is all personal preference. You can do whatever you prefer here. So if you didn't know, this is how Bollinger Bands work. The center line is a moving average. So whatever amount that length is, this indicator is going back that many candlesticks and finding the average between them. So for this strategy, we are going back 30 candlesticks. The lower and upper lines are standard deviation lines. Alright, we got the Bollinger Band set up. Now let's add RSI. To do this, just go to your indicators tab, type in RSI, and then click this top one that says Relative Strength Index. Now that we have RSI added, let's modify the settings a bit. Make sure the upper band is set to 70 and the lower band is set to 30. Then the length is probably set to 14. For this specific strategy, we want it to be set to 13. If you haven't used RSI before, it's a great indicator to tell you if a certain security is being overbought or oversold. If the line is above the 70 value, it's being overbought. If the line is below the 30 value, it's being oversold. Now it's time to pair these two indicators together and get some profitable trades going. Make sure you watch the rest of this video because I'm going to explain a crucial tip to make the strategy go from working just okay to turn it into a money-making machine. So there are two different strategies you can choose from when using these indicators. Both of these strategies are built around the concept called mean reversion. What's mean reversion, you may ask? Well, mean refers to the word average, and the word reversion means returning to. So to put it simply, the phrase mean reversion just means returning to the average, which is exactly what we're going to be shooting for with this strategy. So as an example, in most cases, if there's an extreme price movement in one direction, whether it's up or down, we can pretty much predict after that big price movement that the price will return back to the average, the moving average right here. So if the price goes above the upper Bollinger Band, we want to enter a short trade. If the price goes below the bottom Bollinger Band, we want to enter a long trade. Simple enough, right? Well, if you did this by itself, odds are it wouldn't work too good. That's why we added the RSI earlier. So as you can see in this example, the price went above or below the Bollinger Bands many times, giving lots of false signals. So if you went in every time here, you probably lost money. To solve this issue, we are going to add one more requirement. You can only go in if the RSI hits an extreme value, meaning we can only enter a long trade if the price moves below the lower Bollinger Band and the RSI goes below the value of 25. For shorting, we will only enter a trade if the price goes above the upper Bollinger Band and the RSI goes over the value of 75. So as an example here, we are looking at Apple and the price starts going below the bottom Bollinger Band. But at this point in time, the RSI is still not where we want it to be. So we waited out a bit until the line goes below 25, which it proceeds to go down all the way to 20. We enter a long trade at this point and the price returns to the average just like we predicted it would. Now, there's some crucial information you need to know about this strategy or else it simply just won't work. This next tip I'm about to tell you is the difference between making this strategy profitable or making it a money loser. Where this strategy has its faults is when the market is moving sideways. For almost all trading strategies, when the market is moving sideways, it's a lot harder to predict. So as an example here, the price goes below the lower Bollinger Bands and the RSI is below 25, but the price just keeps on dropping and dropping. So if you entered here, you would have an absolute massive loss. So now I'm going to show you a nice little trick so you know what the price is going to do before it even happens. So in this example, notice how skinny the Bollinger Bands are at this point in time. They are very close together and there's barely any price movement, and the market is moving sideways. You can also see that the RSI is being very tame and staying in between the purple rectangle and not going above or below the major points we made before. This alone should immediately raise a huge red flag. Most times when the market is like this, moving sideways for a while, when the price does break in a certain direction, it goes in that direction with huge amounts of momentum. So in these types of examples, you never want to trade trying to catch a falling knife when the price starts acting like this. Let me show you another strategy we can use to help solve this that works like absolute magic. Here you can see the price starts to drop to the lower Bollinger Band and then reverses. The next time it comes down, it makes a new lower low from the previous low, but something interesting is happening. The RSI made a higher low. So we have price making a lower low, but the RSI is making a higher low. This right here is called divergence, and it's an absolute great sign to enter a trade, especially if RSI was previously below 25 and the price went below the lower Bollinger Band. If this this happens, there's an extremely great chance the price will reverse and make a new higher high. I just showed you how to pair the Bollinger Bands with RSI and make it a profitable trading strategy. All I ask in return is if you can take 2 seconds out of your day and like this video. You should also watch my other video where I go over my MACD strategy, which gets an 86% win rate, which is absolutely insane when it comes to trading. So go check that out, and I'll see you guys next time. This MACD strategy I'm about to show you is one of the highest win rate strategies you can possibly do in trading. It is very easy to use, works in almost every single market, and most importantly, it makes money. Well, enough talk, let's get straight into it. The MACD, or the moving average convergence divergence, is one of the most popular technical indicators used by traders. Essentially, this indicator uses moving averages to find trends in the market, and it's pretty damn good at it too. Now, if you're an experienced trader, you've probably used or heard about this MACD indicator before, but the MACD indicator by itself is just alright, to be honest. So make sure you watch this full video to see how I pair it with some other indicators to make it perform so much better. First things first, let's add the MACD indicator to our chart. To do that, you're going to go to TradingView or whatever chart website you prefer, and then you're going to go up here to the Indicators tab, type in MACD, and click this top one. Now that we have the MACD indicator added, let's make sure we know how the MACD actually works. The MACD is made up of 4 different components: the MACD line, the signal line, the histogram, and the zero line. The MACD line, which is the blue line, in most cases is usually a 12-day moving average. The signal line, which is the orange line, is usually a 26-day moving average. Next, we have the histogram, which represents the difference between the MACD line and the signal line. So, for example, the smaller the space between the 2 lines, the smaller the histogram gets. The bigger the space, the bigger it gets. You can also see once the MACD line crosses above the signal line, the histogram turns green, and if the MACD line crosses below the signal line, it turns red. And finally, we have the zero line, which basically represents the center of the MACD indicator. Now that we know the 4 components, let's make sure we know how to use them. The MACD indicator is insanely good at finding trends in markets. How you can tell if a chart is about to have an upward trend is by looking for a cross upwards between the MACD line and the signal line. For example, here the MACD crosses above the signal line, indicating the chart is in an upward momentum. And here the MACD crosses below the signal line, indicating it's in a downward momentum. You can also use the histogram to indicate how much momentum there actually is. So if the histogram is getting bigger, that means there is an increase in momentum. If it's getting smaller, there's a decrease in momentum. So how you actually want to use this indicator is by when the line crosses upwards, but only if they cross below the zero line. If they cross and it's above the zero line, you wouldn't want to enter the trade. It's the same concept with shorting. You only want to enter a short trade if the lines are crossing downward and it's above the zero line. So as you can see just by watching this indicator is extremely easy to use. But the problem most traders encounter is that they only use this indicator by itself. Let me tell you why this doesn't work. The MACD indicator works extremely well if the market is in a trend. So for example here, the MACD indicator is doing a great job indicating when the price is about to move upward because the chart is in an upward trend. But here the price is in a downward trend, but the MACD is still signaling to buy long even though the price is going down. A simple fix to this issue, for example, if we're trading long, we only want to trade if the market is in an uptrend. You never want to trade against the trend because the odds will always be against you. So an easy way to figure out if the market is in an uptrend, you simply just need to add a 200-day moving average. To do this, you're going to go to the Indicators tab on TradingView and type in EMA, which stands for Exponential Moving Average or Moving Average Exponential. Click the top one. Then you're going to go here, click the settings of the EMA, and you're going to go to Inputs and change the length to 200, which is going to make it a 200 exponential moving average. Then you're gonna go to style, and I like to make mine red, but you can make it whatever color you want. Once we have the EMA indicator added, you'll see just a single line. If the price is above that line, the market is in an uptrend. If the price is below that line, the market is in a downtrend. So after learning that we only want to trade in an uptrend market if we're going long, so all we have to do is put it all together. We buy if the MACD line crosses below the 0 line mark and the current price also is above the 200-day moving average. This will guarantee that you are only trading when the market is in an uptrend, which is a very powerful combo. If you wanted to short, you would do the exact opposite. So make sure the price is below the 200-day moving average and the MACD lines are crossing downward above the 0 line. So as an example, we would want to enter a long trade right here because the MACD lines are crossing upwards below the 0 line and the current price is above the 200-day moving average. Now what I like to do is set a stop loss below the 200-day moving average. So the 200-day almost acts as a wall that the price has to break through to hit the stop loss. Then I like to have a 1.5 profit ratio for my profit target mark. So as you can see for this example, the strategy worked exactly as we wanted it to and we made money. But we can still make this trading strategy even better. This MACD strategy combined with a 200-day moving average works extremely well only if there's a lot of price movement. Where the strategy starts to get kind of iffy and giving false signals is when the chart starts going sideways and losing momentum. So as you can see here, the chart is moving sideways and lost almost all of its upward momentum, and the MACD is giving lots of false signals. If you traded here, odds are you probably lost money. To fix this issue, we have to combine the MACD with price action. To do this, identify a key support or resistance where the price hits and bounces. So as you can see, the price goes down, hits this point, and reverses upwards. The next step is to wait for that price to hit the same key level again, and once it does, we are expecting the price to bounce off the support and go upwards just like it did before. But as a clear side note, just because we made this support and it bounced off this before doesn't mean that it'll always do it again. It can easily break through the support and drop lower if it has enough momentum. If we want to make sure the price is about to change in momentum, that's when we bring out the MACD indicator. So what you would do is make sure the price is above the 200-day moving average. Once the price hits the support made, wait for the lines on the MACD to cross below the 0 level, and that's when you enter the trade. I just revealed to you how the MACD 200-day moving average and using support and resistance levels gives an extremely high win rate with this strategy. All I ask in return is if you can take 2 seconds of your time and like this video. If you want to stay up to date with my future strategies, make sure to subscribe because in my next video I'm planning to release a strategy that works even better than this MACD strategy. Hope you guys all learned something from this video, and I'll see you guys next time.